Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at NTES, or NetEase Inc. NTES is an internet technology company engaged in the development of applications, services, and other technologies for the internet in China. Here's the barchart.com technical opinion rating for NTES. The bar chart rating is a 100% buy with a strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that NTES is well above the moving average line, so the monthly trend in NTES is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in NTES is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. NTES is below the upper Keltner channel line, so NTES is inside the buy zone. Since the trend is up, we want to buy a call. NTES has 7 option chains to choose from. We're going to use the DEES 15 option chain. Right now, the December 15 options have 47 days to expiration. Here is the NTES option chain for DEES 15. NTES closed at 106.78 on Friday. That means any calls on the list from 45 to 105 are in the money. Let's take a look at the profit potential for purchasing the 105 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 105 call is 720 to 750. We try to enter at the midpoint, so we'll use 735 as the buy price. Our call option calculator shows the profit potential for this call based on NTES price changes at option expiration from flat to a 12.5% increase in price. We can see that if the NTES stock price is flat at 106.78 at option expiration, the 105 call would lose 75.8% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 95 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 95 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the NTES stock price is up 1%, the 95 call will lose 8.2% of its value. We want that to be break even or better, so the 95 call does not meet our requirements. Let's see if the 85 call will work. The bid-ask spread for the 85 call is 21.80 to 23.60. We tried to enter at the midpoint, so we'll use 22.70 as the buy price. The 85 call works. If the NTES stock price is up 1%, the 85 call will make a 0.7% or $15 profit. That's better than break even, so the 85 call is the one we'll buy. The call option purchase calculator also shows, excuse me, well, sorry about that if the NTES stock price, lost it, sorry. Going into back, the 85 call works. If the NTES stock price is up 1%, the 85 call will make a 0.7% or $15 profit. That's better than break even, so the 85 call is the one we'll buy. The call option purchase calculator also shows that if the NTES stock price increases by 2.5%, the 85 call will make a 7.7% or $175 profit. If the NTES stock price increases by 5%, The 85 call will make a 19.5% or $442 profit. If the NTES stock price increases by 7.5%, the 85 call will make a 31.2% or $709 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the NTES stock price does not make the expected move up and remains flat at expiration, the 85 call would only lose minus 4.1% or minus $92 compared to the minus 75.8% or minus $557 loss for the 105 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the NTES December 15 95 strike call and sell to open the DEES 15 100 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 95 call for 14 and sell the 100 call for 1045. 1045, 14 minus 1045 equals 355. So the entry price or debit cost for the spread is $355. The call option spread analysis calculator picture shows that the spread will make a 40.8% or $145 profit if the NTES stock price declines by 5%, remains flat, or increases in price when the options expire. If NTES is down 7.5% at expiration, the trade will make 6.2% or $22. Creating the debit spread will allow us to collect a $1,045 cash credit to our brokerage account for the sale of the 100 call. As we said on the previous slide, this reduces the cost of entering the spread to $355. Here's a note regarding earnings reports. The next NTES earnings report is scheduled for November 15. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the NTES DEES 15 85 strike call for $22.70. We also reviewed the spread. The spread said to buy to open the NTES DEES 15 95 strike call and sell to open the DEES 15 100 strike call at a debit of $355. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.